Principles of finance, a la shmup. Time doesn't heal all wounds. So you probably already know where our story is going to end. It's a fable, and fables ain't fairy tales, especially on Wall Street. Well, this yarn hinted at the sales of Thunder Drone being oh so less than awesome, and 2 quarters later it turns out that they were oh so less than awesome. The early optimism around the IPO was driven by huge free marketing in the press writing about this new Thunder Drone, massive expectations, but under $50 million worth of free marketing thanks to all the articles written about the company re-IPOing. Well, BRND only sold $20 million worth of Thunder Drones. And that was in the first month and change of that first quarter of being public. And then things really fell off a cliff, literally. You try to explain these metrics to your partners, but they're busy shopping for jets as they count the days until they can sell their stock. Add to this kerosene the fact that it turned out that the economy in the US and around the world was softening. That fact hurt the extra toy money of well-to-do tech-loving geeks. It also turned out that, shockingly, a large part of the country does not in fact live right near the ocean. Maybe in Tuvalu, the demographic parity would have been better with this product. And as the company turned its attention to this new bright shiny thing in underwater drones, well, it let its core business slip a bit. Just 5% revenue and unit growth in Q1, which turned out to be a disappointment for the street. Instead of printing up revenues of 20%, the company across all division, products, and countries was up only 12%, with earnings actually down. That is, the IPO cost a lot, the marketing cost a lot more, production snafus cost even more. So the stock moved from $200 to $80 on that news, down $120, delivered after the first quarter that the company was public. Ouch. For you and your gang and the founder and the employees and the trusting post-IPO stock buyers, it's called a wealthectomy. Then came Q2, and recall that the private equity firm will have had to have held the stock for 2 full quarters, then the quarterly call has to happen, then there has to be at least 3 trading days that pass before that private equity company can sell anything. Welcome to the land of 144A restrictions done for just this type of situation, where insiders know there's a bad moon arising and Joe Sixpack blindly, faithfully buys a stock being marketed to him even though he has inferior information. And then, of course, figuring into things is the fact that your firm owns a massive amount of shares of the company, so it can't just pull a trigger and sell all 20+ million of them right away the first day their trading window opens. Instead, the agony in the equity has to file a special form with the SEC, it's called the 10b5-1 form, which spells out under what terms and conditions it'll be selling its stock, and usually those filings come with all kinds of restrictions, some of them regulatory and some of them logistic. That is, if a company owns 2/3 of all the float or shares currently trading, well, it might have to limit sales to be something like, well, no more than 10% of the average daily volume is measured by the trailing 30 days averages, blah, blah, blah. No more than 1% per week of the total holdings. No sales happen below, say, some number of $50 a share, and so on and so on. So many rules, so many regulations, more than you find in your typical fairy tale, which should be your first clue here to what's coming.